Hey guys, how's it going? And welcome back to another video on Patrick Tutors. Today we will be talking about the put-call ratio, how to calculate it, and what it represents. So let's begin by showing you guys the formula. So we have stock ABC, and obviously stocks ABC, EFG, and XYZ are not real stocks. They're just examples. So ABC equals the put-call ratio, which is your volume of the puts, PUTS, over the volume of the calls, are listed in the far right column. Okay, now let's solve for each of these. So we're going to begin by taking stock ABC as listed below. ABC equals the puts, which is 4,200. That's the volume. Those are all listed. You don't have to solve for the volume, thank goodness. Over your call, which is just an even 6,000. This equals 0.7. That's a point right there, sorry. Okay, next we're going to calculate for stock EFG. So we have our EFG equals, so our puts would be 1350, as you can see there, 1350, over our calls, which is 6150. And this calculates out to right around 0.22. All right, and lastly, we have stock XYZ. So for this one, the puts are a little bit higher than the rest. They're 9,125 over your calls, which are a little bit lower than the rest at 3,375. This equals around 2.7 if my math is right. 2.7, that right there was a point, sorry. Okay, so now that we have calculated the put-call ratio for all these stocks, we have to answer the second part of the question. It says, then describe the overall market sentiment for each stock. So what this problem is basically asking is the stock bearish or is the stock going to be bullish? So bearish stocks means that the overall stock price is going to, or most likely going to, decrease. If it's bullish, then it will most likely increase. So how to read these put-call ratios? So basically, the higher the value is, so here stock XYZ has a ratio of 2.7. The higher the ratio, the more bearish the stock is. So remember, bearish, it goes down, or is estimated to go down. Bullish, it's estimated to go up. So when you go to buy a stock, you want to buy it when it's bearish, and then hopefully the stock will be bullish and the value of your stock will rise. So EFG is clearly the most bullish because its put-call ratio is the lowest. So 0.22 would be a bullish stock. And I mean, you always want to buy bullish stocks, but like Apple, you know, the value right now is so high, you would want to wait for it to go bearish and drop in value and then buy. Because with Apple, it's a humongous, like, I guess, brand, if you will, and their value is bound to rise. So you always want to try and buy when it's bearish and avoid buying when it's bullish because the stock market is so like volatile that it's bound to be bullish once more. So before we go any further, I want to talk about what a put option is and what a call option is. So a put option basically gives the stockholder a right to sell the stock at a predetermined cost. A call option, on the other hand, basically gives the stockholder or the stock owner an option to buy the stock at a certain price. So one's to sell at a certain price, which would be the put ratio, and then a call ratio is to buy at a certain price. They're kind of opposites of each other. So basically, guys, what this means is that when a stock price goes up or increases in value, your call ratio or your call option will also go up. But on the other hand, if the stock were to decline in value or decrease or simply go down, your put option will increase. If your stock were to go down, your call would go down. If your stock went up, your put option will go down. So that's basically how this works. So if the stock market is rising, call options will be much more popular. If the stock market is decreasing, call options will be much less popular, but the put option will be a lot more popular. So when the stock market's rising, you always want to do a call option. When it's decreasing, you always want to do a put option and avoid the call options. So on stock XYZ, people will be placing a lot more put options than call options because they believe that the stock market or the price of this stock in particular is going down, so they will put in put options as opposed to call options. Now, if you look at stock ABC, call options are clearly going to be more popular because they believe that the stock is rising. So the potentiality of a call option being placed is a lot greater because the stock is more bearish as opposed to that of XYZ. So if you will look over here at the chart for XYZ, you can see that a lot more people are selling than buying. That's because the put-call ratio indicates that the stock's bearish and the price is going to go down. Now, in opposite of that, if you look at stock EFG, you can see that a lot more people are actually buying the stock than selling because it is very bullish. Now, ABC is more of a middle-of-the-road stock, if you will. I mean, it's still a pretty awesome buy, but not as many people are buying as EFG, but there's still more people buying as opposed to selling. So your best stock would be clearly EFG, ABC would be your second best, and XYZ would be the worst stock here. If you were personally in the stock market, I would recommend buying stocks 1 and 2 and avoiding 3 at all costs. So in short, a low call option is telling you that a lot of people are selling. A low put option is telling you that a lot of people are buying. So buying a stock is a little bit challenging because you always want to make sure that you're buying a stock on the way up and not the way down, or buying a stock at the very bottom. So when a stock is bullish, it's tough to decide when to buy. I mean, you always want to buy, but if that stock's already at like its highest dollar value, you might want to avoid it and buy a stock that's a little bit more bearish. And put call ratios are not always 100% right. I once owned a stock and it was very bullish, and it actually decreased in value from about $9 all the way down to $2. So there's a lot more to the stock market than put call ratios, but these ratios can really help you, I guess, get a good feeling for what the stock is going to do. Most of the time they are right, but just remember that they aren't always right and they can be wrong. So EFG is clearly very bullish, and XYZ is clearly very bearish. So what about ABC, right? I mean, it's clearly not totally bearish, but it's not completely bullish either. Well, this stock would be classified as a neutral stock. So neutral stocks are ones where the stock price or the stock value is pretty stagnant and it's not really going to move too much. So EFG is estimated to rise in value, XYZ estimated to decrease, and ABC, if you will, is just estimated to really flatline. So there's not really much to that. So to conclude this video, basically any ratio that is under 0.5 is going to be bullish. Anything in between like 0.5 and 1 is going to be neutral. And anything over just 1 flat, like the stock here, XYZ, is going to be bearish. Alright guys, that concludes today's video. I hope you learned something and enjoyed. Please like, comment, subscribe. Comment for what videos you want to see in the future, and I will make sure to post those for you guys. Alright, thank you so much. Cheers. Bye.